My financial nerds, my brethren, let's talk about how to determine which assets to choose for your own personalized asset mix, also known as asset allocation. Asset allocation, your personal investment bespoke cocktail. Now we get to something a little exciting. Asset allocation, the heart and the soul, the not so secret sauce of your financial portfolio. If you're like a financial nerd like me, you like maximizing your 401k, or you like the thought of maximizing your 401k like I do when I'm min-maxing my Diablo 4 sorcerer character, this section is gonna be for you. And it's not this one size fits all beverage for the masses. What we're doing is making a meticulously crafted cocktail where every drop or asset has a purpose, and the taste of victory is simply intoxicating. This is where you're normally gonna hear typical finance people talk about walking down the beaten path. This is typically a dull blend of 60% stocks and 40% bonds. Like we talked about before, one size fits all for the masses might not be necessarily optimal for you. Asset allocation is about understanding your individual financial palette and then serving up an investment mix that doesn't just make sense on paper, but gets your financial taste buds and brain cells and returns tingling, potentially. So how do you figure out your own asset allocation? First, you need to understand what kind of investor you are. A thrill seeker who gets a kick from market swings? Or are you the cautious type who'd rather stick to the slow and steady lane? Because seeing your portfolio, even if it's on paper in the short term, drop significantly or vary between 10%, 20%, it's hard for you to stomach even if those are unrealized losses. This is what we're gonna call risk tolerance. It's gonna be as unique as your thumbprint. Assessing this can be a little tricky. There's plenty of questionnaires and financial advisors out there that can help guide you. And you're gonna have to consider the things like your age, your income, financial goals, and your emotional ability to deal with losses, unrealized or realized. So what you can do is just Google risk tolerance questionnaires, and then you'll get a bunch of different things that you can work with. And I'll put some links in the description below. This is nothing concrete. This is very basic 3-question questionnaire. So don't put too much weight into it, but it'll help you at least try to guide you in the right direction. First question is around goals. What are you investing for? Answer A is long-term growth, financial security. I'm thinking decades down the road. B is a balance of growth and stability. I want my money to grow, but I don't want to risk it all. And then C is safety. I'd rather protect my capital than chase huge returns. Question number 2 is on timeline. When will you need the money? A, not for 20 years. B, probably within the next 20 to 10 years. And then C, within the next decade. 3, sleep factor. How would you react if your investments took a 20 to 30% nosedive overnight? A, yawn. I'd sleep like a baby knowing the market ebbs and flows. 2, I'd be concerned, but I wouldn't hit the panic button. 3, I'd be reaching for antacids and seriously considering cashing out. Tally up your answers. Are you mostly A's? Then you have a higher risk tolerance. Are you mostly B's? Then you're somewhere in the middle, moderate risk. And if you're racking up the C's, you're likely a more conservative investor. Again, this is just a fun quiz, but take it with a grain of salt. Remember, this is just a starting point and gauge for your risk appetite. To truly understand your risk tolerance and align your asset allocation with it, you might consider consulting with a financial advisor or taking a more in-depth quiz. Now that you start to understand a little bit of your appetite for risk, people who are younger and have ice flowing through their veins can handle the wild ups and the downs of the market. However, if the thought of watching your 401k balance drop during a market downturn gives you nightmares and cold sweat, then you may want to stick to a heavier allocation of bonds. Once you've got a handle on your risk tolerance, then you can start carving out your asset allocation strategy. If you're younger and have a higher tolerance for risk, you can lean heavier into stocks, especially those that are growth oriented, small cap, emerging market stocks. If you're older, more risk averse, you might want to swing towards more bonds or large cap stocks. A higher risk tolerance doesn't mean you should be gambling with your 401k. Think of it as being able to take calculated risk for higher returns. And I emphasize calculated because it means doing the hard work, the extra work, and the research between what the higher risk investments are, like emerging markets or crypto, for example, and then looking at the realistic gains. What are the realistic downsides and risks associated with those gains, and your risk tolerances being able to weather the storm, the volatility, and accept those downside risks for the potential gain. And even when you have a high risk tolerance, you need to practice risk management. This is an in-depth concept for a future video, but for now, you want to just always ask yourself, what are my risks? What can I do to reduce those risks or prevent them? I'm a crypto and NFT degen in trading and investing in these extremely volatile assets in my other accounts. And I believe in blockchain and Web3 in the long term, but I don't take those same risks inside my 401k. Why would I do that in the grand scheme of risk management and what we were talking about earlier? What is the biggest risk for investing in Bitcoin and crypto? It's the volatility and the massive swings. What does this mean? It means you don't want to buy the top of a hot crypto cycle and then see it crash 50 to 80% or more later. And where I got this concept from, besides other ways that I was trading and without getting too technical, Raul Paul put it simply best by explaining it this way. Raul is the CEO of Real Vision Finance and former executive of Goldman Sachs, and he says he would have made more money if he just accumulated crypto at market lows and held it instead of trading it. And for my own experience, besides trading NFTs, I experienced the same thing. And even though I was able to do successfully well trading and having that liquid cash, it actually would have made me more money if I just accumulated at those lows and held instead. All of this also has the assumption that crypto and Bitcoin is here to stay and is going to be moving into the future, which I personally have. So that's how I would risk manage my 401k portfolio if I were to put in a little bit of crypto. And so that's what I wanted to explain by taking calculated risk, is looking at what the potential downside is and then protecting against it as best as you can. And this accounts for my own personal finance situation because my risk management for my entire portfolio and how my 401k fits inside it, I treat my 401k as a hedge against my higher risk activities and investments inside crypto. The account that I know historically averages an annual rate of return around 5 to 8% for the standard 60% stocks and 40% bonds asset mix. So that's my benchmark and likely result. And looking at the current 401k performance, I'm on track to retire comfortably, even if my crypto investments in trading completely flops, fizzles out, and just goes away. So how do I protect against this? I make sure that I was building and growing my 401k so that I don't need crypto at all to retire comfortably. So that's what I focused on. Do I need crypto to retire earlier? Yes. Would it suck if crypto completely blew up and I lost all my money? A resounding and utter yes. Do I believe it'll go to zero? At a high level for Bitcoin and Ethereum at least? No. But I can't predict the future, so I risk manage for it in various ways, with one being my 401k. That's how the 401k fits in my overall financial situation. It'll be unique to you and your own needs and goals, and so that's what you want to adjust for. And remember the golden rule: diversify, diversify, diversify. It's the financial equivalent of not putting your eggs in one basket. A well-diversified portfolio will contain a mix of asset classes, and you get to spread the risk among those investments in various sectors and countries. And again, sounding like a broken record with index funds, they offer a simple way to achieve broad market diversification. So focus on broad categories: stocks, bonds, cash equivalents, and within stocks you can diversify further: domestic, international, large cap, mid cap, small cap, growth, value. And with bonds, you can diversify among government, corporate, international bonds, and then the different varying lengths of maturity. What about believing in emerging technology or market? This is where investing gets interesting. You're convinced that, say, renewable energy or blockchain technology is the next big thing. You might choose to invest your funds and focus on those sectors. But be careful, this type of investing should still form part of a broader diversified portfolio. And be careful and understand the risk if you put all your faith and hard-earned money into one trend. Here are example asset allocations for your 401k. First one is Warren Buffett's advice. Warren Buffett's advice is to have 90% in low-cost S&P index funds and 10% in short-term government bonds that can work for your 401k, especially for young investors with a high risk tolerance and a long investment horizon. 2. Take the age-based approach. This involves subtracting your age from a number like 1 or 120 to determine the percentage that your portfolio should be invested. For example, a 30-year-old could have 70 to 90% of their 401k in stocks and the rest in bonds or lower risk investment. 3. The all-weather portfolio. Let's switch gears and turn to one of the sharpest minds in the investment world, Ray Dalio. He's not your average Wall Street honcho. He founded Bridgewater Associates, which is one of the largest hedge funds and has a knack for making bold contrarian predictions that often hit the mark. Ray Dalio's all-weather portfolio is on the idea of creating a diversified portfolio that should perform well across all economic environments. So here is the asset allocation he suggests. 30% in stocks. For long-term growth, you could use a low-cost total stock market index fund. 40% in long-term bonds tend to do well when economic conditions are poor. 15% in intermediate term bonds, hedge against deflation. 7.5% in gold. Gold is a traditional hedge against inflation. And 7.5 in commodities. Other commodities can also provide a hedge against inflation. And here's some findings from Vanguard. Vanguard, one of the world's largest investment companies. And according to the Vanguard report, their investor median stock allocation was about 88% for investors in their 20s, which gradually decreased to around 50% for investors in their 70s. Again, investing is not a one-size-fits answer. Your best asset allocation may look very different from these examples. This is just to give you some insight into what they're thinking so that you can create your own plan. The key is to create a plan that you're comfortable with and that you stick to.